Welcome back to the deep dive. We have a really interesting stack of research today because we are tackling a subject that is, let's be honest, usually the quickest way to kill a dinner party conversation.
It really is. It's the A word.
Accounting. Yeah. Accounting. But before you, the listener, hit pause or skip, you need to know that our source material today, Accounting Made Simple by Mike Piper, isn't about boredom.
No.
It's about defense. It's about not getting fleeced because you just don't speak the language.
That is the perfect way to frame it. I mean, Piper's whole thesis is that accounting is the Rosetta Stone of business.
Right.
And if you don't speak it, you're walking through the marketplace completely blindfolded. And what's so interesting is the context of when this book actually hit the shelves.
It was published in 2010.
Exactly. Think about that timing. The dust was just settling on the 2008 financial crisis. The entire global economy had just, melted down.
People were angry.
Angry, but more than that, they were confused. They realized that the whole just trust the experts model had completely failed them. They felt this desperate need to understand how money actually worked, or they were just going to get crushed again.
And that's where Mike Piper steps in. He's a CPA, a certified public accountant, but he writes like a normal human being.
Yeah.
He saw that the gatekeepers, the academics, the high-level consultants, they had made this stuff intentionally dense. He wanted to strip away that whole black box nature of it.
He calls it the intimidation factor. Most people just hand their finances to a professional once a year. They cross their fingers,
Right.
and they hope they aren't bankrupt.
Right.
Piper says that's an abdication of responsibility.
Yeah.
You don't need to be a CPA to read a financial statement, just like you don't need to be a mechanic to know when your car's overheating.
So that is our mission for this deep dive. We are going to bypass the textbook definitions and get straight to the utility. By the end of this, we want you to be able to look at a balance sheet and actually see a story, not just a wall of numbers.
And a quick note for our longtime followers, this deep dive is part of the Better Every Page project on YouTube. So let's get into the engine room. Piper starts with the foundational documents, what he calls the Big Three.
The big three financial statements. So the balance sheet, the income statement, and the cash flow statement. Let's break these down, but not as definitions. Let's talk about what they do.
Okay, start with the balance sheet. Piper uses this snapshot analogy, which is just perfect. Imagine you freeze time at midnight on December 31st. Click. The balance sheet is that photo.
So it's totally static. It tells you in that single frozen moment what you own and who you owe.
Precisely. It's a measure of health at a specific point. It doesn't tell you how you got there, just where you are right now. Now, contrast that with the income statement.
Okay.
If the balance sheet is a photo, the income statement is a video.
Because it covers a duration, a period of time.
Right. It's the story of what happened between January 1st and December 31st. Did you bring in more than you spent? It tracks performance over time. It's the narrative arc of the business year.
Okay, so health, that's the balance sheet, versus performance, that's the income statement. But then there's the third one, which Piper seems to suggest is the only one that never lies.
The cash flow statement.
The truth teller.
Yes, the truth teller. Because here's the trap people fall into. You can look at an income statement and see a massive profit. You think, great, I'm rich. But then you look at your bank account and it's empty.
Because profit is an accounting concept, but cash is reality.
Exactly. You might have sold $100,000 worth of goods, but if the clients haven't paid you yet, your income statement says profit, but your cash flow statement says broke.
Wow.
The cash flow statement tracks the actual movement of hard currency. It tells you if you can actually make payroll on Friday.
That distinction, profit versus cash, is probably the #1 reason small businesses fail, isn't it? They run out of cash while technically being profitable on paper.
It happens all the time. That's why Piper emphasizes checking all three. You need the photo, the video, and the truth teller to get the full picture.
Which brings us to the gravity that holds all of this together, the math. Now, I know math triggers some PTSD for people, but this equation is actually kind of elegant.
It is the golden rule of accounting.
Yeah.
Assets, liabilities, plus equity.
Let's unpack the logic here, because this was a real light bulb moment for me reading the notes. It's not just an equation, it's a statement of origin.
That's a great way to put it. Think of it this way. An asset is anything the business has.
Cash, trucks, buildings.
Patents, anything. The equation simply says everything you have must have come from somewhere.
And there are only two places it can possibly come from.
Right. Either you borrowed money to get it, that's a liability, or you used your own money or maybe past profits to get it, and that's equity.
So if I see a company with a massive headquarters building, that's the asset. To make the scales balance, the other side of the equation tells me who actually paid for that building. Was it the bank, the liability, or was it the shareholders of the
Perfect.
equity?
You've got it. And this leads right into the mechanism that keeps those scales balanced all the time. Double entry bookkeeping.
This is the part where people's eyes usually glaze over, but it's actually just a system of checks and balances.
It's just Newton's law applied to money. For every action, there's an equal and opposite reaction. So if you buy a laptop for your business for $1,000 cash, two things happen.
Okay.
One, you have a new asset, equipment worth $1,000. Two, you have less of another asset, cash, by $1,000.
So plus 1,000 minus 1,000, the net change to your total assets is 0. The equation stays balanced.
Exactly. But what if you put it on a credit card?
Let me try this. Equipment. The asset goes up by $1,000, but I didn't spend cash. So accounts payable, which is a liability that goes up by $1,000.
Spot on. Assets increased and liabilities increased by the same amount. The equation still balances.
And this is where those scary words debit and credit come in. Piper basically says to just stop overthinking them.
He does. People think they're these mystical forces of good and evil, or that credit always means good and debit always means bad. They aren't.
They're just directions.
Just directional instructions, left side and right side. They are just the tools accountants use to make sure that double entry system we just described doesn't break. I mean, unless you're becoming a professional bookkeeper, you just need to know that they're the mechanism, not the message itself.
Let's move to something that actually changes the numbers on the page. The difference between cash accounting and accrual accounting. Piper identifies this as the moment most side hustles need to become, real businesses.
This is a huge aha moment. Most of us live our personal lives in cash accounting. If money hits the bank, we have money. If money leaves, we spent money. It's simple.
It's like a checkbook.
Exactly. But businesses use accrual accounting, and this focuses on timing. In accrual, you record the transaction when the activity happens, not when the cash moves.
The example in the book was the graphic designer.
Right, you do a huge project in January. You invoice the client for $5,000, but they don't pay you until March.
Right.
If you use cash accounting, your January looks terrible. You did all that work and show zero revenue.
Which is pretty demoralizing, frankly.
It is, and it's inaccurate. If you use accrual accounting, you record that $5,000 in January because that is when you earned it.
So accrual actually matches the reality of your effort to the financial result.
Yes, it stops you from panicking in January or getting this false sense of wealth in March when the check finally clears. It just smooths out the lumps so you can see the real trend of the business.
This ties directly into the matching principle, which sounds super technical, but is really just about honesty.
It's about not lying to yourself. If you buy 1,000 t-shirts in January to sell in February, you shouldn't record the cost of those shirts in January. Why?
Because you haven't sold them yet.
Exactly. You hold them as inventory, which is an asset. Then in February, when you sell them, you record the revenue and you record the cost at the exact same time. You match the expense to the revenue it helped create.
That way you can see if that specific transaction was actually profitable.
Precisely. Otherwise, January looks like a disaster because of the huge expense, and February looks like a miracle with huge profit and zero cost. The matching principle makes the story coherent.
Speaking of the story, let's talk about how you can tweak this story. Piper talks about valuation and inventory. And this is where we get into FIFO and LIFO.
First in, first out versus last in, first out. It sounds like a dog's name, Fido and LIFO.
Right.
But this is actually a really important strategic lever. Let's say you sell widgets. You bought some last year for $10, and you bought some this year for $15 because of inflation.
Okay.
You sell one widget today for $20. Which one did you sell, the $10 one or the $15 one?
Physically, it doesn't matter. They're identical.
Yeah.
But for accounting purposes, it matters a lot.
Huge. If you say you sold the $10 one, that's FIFO, your profit is $10. If you say you sold the $15 one, that's LIFO, your profit is only $5.
So in a time of high inflation, using LIFO makes your profit look lower.
And why would a business owner want to look less profitable on paper?
Taxes.
Bingo. Lower profit on paper means a lower tax bill today. The cash in your pocket is exactly the same, but the accounting method changes how much you owe the government. That is why understanding this isn't just about compliance, it's about strategy.
This leads us nicely into the broader philosophy of the book. I mean, Piper isn't just teaching mechanics. He's fighting a kind of culture war. He's taking on the priesthood of finance.
He really is.
Hmm.
There is this tendency in the financial world to gatekeep. You have textbooks like Donald Kiso's Intermediate Accounting, which are brilliant, don't get me wrong, but they're like 1,500 pages of dense academic jargon.
They're a barrier to entry.
Completely. Piper is saying that financial literacy is a right, not a privilege reserved for an elite few. He's democratizing the knowledge.
It's the difference between complexity and utility. You don't need to know how to calculate complex derivatives to run a bakery, but you absolutely do need to know if you're bleeding cash.
Clarity leads to agency. That's the core message. When you treat accounting as this black box, you're anxious because you're flying blind. But when you understand the scoreboard, as he calls it, the anxiety drops. You might still have problems, but now you can define them. And a defined problem is a solvable one.
It's a psychological shift, too, moving from accounting is boring and scary to accounting is the narrative of my business.
Exactly. It's your story. And if you don't know how to read it, you can't edit it. You can't improve the ending if you don't know what happened in Chapter 2.
So let's get practical. We've got the theory, we've got the philosophy, but for the listener who wants to stop flying blind, today, what are the tools Piper recommends?
Well, the first one is just good hygiene, the health check. It's formally called reconciliation.
Which is basically just comparing your books to the bank statement. Sounds tedious.
It sounds like busy work. But Piper argues this is your primary defense line. This is how you catch the subscription you forgot to cancel, or the vendor who double-charged you, or even, in worst-case scenarios, employee theft. If you aren't reconciling monthly, you aren't managing your business, you're just hoping.
It's like brushing your teeth. It's not exciting, but if you don't do it, things start to rot.
A vivid image, but it's accurate. And once you trust the numbers, because you've reconciled them, then you can start diagnosing. This is where ratio analysis comes in.
Piper uses a medical analogy here, right?
Yes. Think of it like a medical checkup. A profit number is subjective. It can be manipulated. But a ratio is a benchmark. Take the current ratio. It's your current assets divided by your current liabilities.
Okay.
It basically asks, if everything went wrong tomorrow, could I pay off my immediate debts?
So if that number is below 1, it means you owe more than you have liquid.
Exactly. You are in the danger zone, even if you are technically profitable. It's giving you the blood pressure reading, not just asking, how do you feel?
He also mentions profitability ratios.
Right. For every dollar of sales, how much do you actually keep? If you sell $1 million of product, but you only keep one single dollar, your business is incredibly fragile. Ratio analysis exposes that fragility before it kills you.
He suggests an exercise that I think every listener should do, regardless of whether they own a business or not. The mock statement.
Yes. This is great. Create a balance sheet for your life. List your assets. Your house, your car, your retirement account, cash. Then list your liabilities, your mortgage, student loans, credit card balances.
And then you do the math.
You subtract the liabilities from the assets. And that number at the bottom, that's your equity.
Yeah.
Or, as we call it in personal finance, your net worth.
It's a really sobering exercise for a lot of people. You realize that buying a boat on credit increases your assets and your liabilities equally. Your net worth doesn't budge. You haven't actually gotten richer, you've just gotten heavier.
That is a brilliant way to put it. You've just bloated the balance sheet without increasing the equity. That insight alone is worth the price of the book. It completely changes how you view debt. Debt isn't just a monthly payment. It's a weight on the equation.
Let's talk about a decision-making scenario. Piper talks about how understanding this stuff helps you make choices, like the LIFO versus FIFO example we touched on, but also cash versus accrual.
Right. Imagine you're a business owner and your accountant asks, do you want to use cash or accrual? If you haven't read this book, you might say, cash sounds simpler. Let's do that.
And for very, very small businesses, maybe that's fine.
Maybe. But if you have inventory or if you invoice clients, choosing cash accounting might make you blind to your actual performance. You might need the complexity of accrual to see the truth.
So the book gives you the confidence to have that conversation with your accountant rather than just nodding along and hoping for the best.
It transforms you from a passenger to a pilot. You are still hiring the navigator, your accountant, but you are the one flying the plane.
Okay, we've covered a lot of ground. We've demystified the big three. We've balanced the equation, and we've looked at the strategy behind the numbers. Let's distill this into the key takeaways for our listener.
Takeaway 1. The equation is everything. Assets, liabilities, plus equity. If you can view every single transaction through that lens, where did this come from and who owns it, You understand the core physics of business. It stops being magic and it starts being mechanics.
Takeaway 2. Financial literacy is a life skill. This isn't just for CEOs. Whether you're investing in stocks, managing a household budget, or trying to get out of debt, you need to speak this language. It is the operating system of the modern world.
And if you don't speak the operating system, you can't run the program. It's that simple.
Exactly. And takeaway 3, move from being reactive to being proactive.
Don't view accounting as just a shoebox of receipts you deal with at tax time. That's driving while looking in the rearview mirror. Use the financial statements to look through the windshield. Spot the cash crunch before it happens. Use the ratios to check your health before you have the heart attack.
That's the whole shift. It turns accounting from a chore into a superpower.
Absolutely. It gives you control. And in a chaotic economy, control is probably the most valuable asset you can have.
So here is the question for you to chew on. Are you treating your financial life like a mystery box, just hoping for the best? Or are you ready to start reading the story the numbers are actually telling you?
The story is there, you just have to learn the language.
Accounting Made Simple by Mike Piper is a fantastic primer for that language. Thank you for joining us on this deep dive.
Keep learning.
This is Better Every Page on YouTube. See you next time.